Hello everyone, I hope that you guys are doing great. So if you remember within the previous lecture, we solved a question of audit risk, and we solved it in a very lengthy way. Particularly, I identified all of the audit risks, and then there was a separate lecture specifically to write down the audit risk within the Word format. I wrote down that specific question so that none of you have any kind of issues when you are yourself solving the questions. From now onwards, whatever question that we are going to attempt from the exam kit or from the study hub or from the past exams will already be solved by me, and you can use those solutions to identify how I have written it down. But obviously, we will refer within the lectures as well, we will refer to the solutions that have been made by me already. So, the question that we are going to attempt within this lecture for audit risk, the name of the question is Knight Electronics Corporation. Knight Electronics Corporation is a recent question that came within one of the recent attempts, and I wouldn't say that it is a difficult question in terms of audit risk, but it is a lengthy question in terms of audit risk. Identification of audit risk specifically here and understanding what is written, how audit risks will be created out of these things, that is a difficult thing within this question. So it takes a lot of time to solve. Normally, the students who try to do this question within exam, it took them more than the hours or the time that should be allocated for this specific question. For example, 16 multiplied by 1.8 is approximately 25 to 28 minutes in which the question should be solved, but majority of my students as well said that it took us more than 30 minutes to solve this question, which can happen in some of the ways. It can happen in some of the exams if the examiner puts in a question that is lengthy to solve. If you look at this question, no financial statements have been given to us within this specific question. Within this specific requirement, no financial statements have been given to us. This means when we were talking about audit risk, I told you that there will be three types of ways an examiner can test an audit risk question within your exam. One was particularly giving you only the analytical procedures, giving you the financial statements, and the examiner will ask you perform analytical procedures to identify risky areas from the financial statements. The other one was it can be combined, both theoretical scenario can be given to you, a story can be given to you in addition to the financial statements, both can be given to you. But in this question, only the story has been given to us, the financial statements have not been given to us. So let's move towards the question. Let's try to solve the question. The requirement that we will be solving is not going to be part A because you haven't studied it up till now within the syllabus. You will study it later on within the next lectures. You haven't studied requirement number C. You don't know what are substantive procedures, and you also haven't studied this one, in which we are asked that what are the responsibilities of an auditor in terms of fraud. So obviously you haven't studied it, so which is why we are going to ignore the remaining of the requirements. We will only move towards 16 marks requirements, which is basically part B, which we are going to solve within this lecture. The requirement asks, explain audit risk and explain the auditor's responses to each risk in planning the audit of Knight Electronics Corporation. So, if you remember within the previous question as well, I told you that there will be some risks that you will always see that they are repeating within every single question, like a new audit line. You will see multiple times that this risk is particularly repeated in many of different questions from your kit to the past exams and within your real exam as well. You will see that if an examiner is asking you to identify, let's say, 8 different types of audit risks, out of those 8, at least 3 or 4 will be the ones that you will see are repetitive in nature. Give me a second. Okay. Okay, so what I was saying is that you will always see that some of the audit risks within your exams will be repetitive in nature. You will always see that one of the audit risks that you learned or you did within one question is also coming in within the second question. And this lecture will be an example to that as well, where you will see that multiple audit risks are repetitive in nature. So let's move towards the scenario. Let's read the scenario. Let's read the question and try to identify the risky areas within the financial statements. So the first thing, the name of the question is Electronics Corporation. I told you within the previous lecture as well that always try to understand what is today's date and what is the year end of the company, because there may be a lot of risks associated with today's date and what is the year end of the company. You need to understand that. So the date is 1st of July 2015. It is 1st of July 2015. Now coming towards the next area for the year ending 30th of September 2015. So I have identified the two things which are important to me as an auditor. What is the date today? I'm rating the question at what is the date today and what is the year end of the financial statements. We have identified both of this. Now let's read the question. It is 1st of July 2015. Your firm, Hercules and Corporation, has recently won the audit of a new client, Knight Electronics Corporation, for the year ending 30th of September 2015. So I told you within the previous lecture as well, and we have discussed this overall so many times, that whenever you have a new audit client, there is always a detection risk. A risk that you will not be able to identify risky areas within the financial statements of this company because you don't have an experience with this audit client. This was the first risk. The second risk was that because you were not the auditor in the previous year of this company, which is why the company management, knowing this, that you weren't the auditor in the previous year, they may manipulate the opening balances within the current year financial statements, and you were in the auditor the previous year, you would not be able to identify that. These both are the main detection risks in this case. In the exam, you can only write down one. Do not write down both of them. You can only write down one. Now, moving towards the recommendation, we also studied that in the case of the first risk, that you will not be able to identify risky areas within the financial statements, misstatements within the financial statements. The only response is that as an auditor, you now need to be more professionally skeptic. You need to increase your sampling so that the detection risk decreases. In the number two case, you have to be more professionally skeptic person for opening balances that might be manipulated by the management. You have to be more professionally skeptic person. Also, you have to ensure that you compare the previous year's signed financial statements, audited financial statements, and compare the closing balances within the previous year financial statements with the opening balances in the current year, so that you are able to identify whether the balances are written down correctly or not. So this is the first risk which I have written here within the notes as well. You can see Knight Electronics is a new audit client for Hercules and Corporation. Number two, where you have to explain this one, the number second part, where you have to explain in your own words which specific items are at the risk of under or overstatement. In this case, we are not talking about the financial statements, so we will explain the detection risk in paragraph number 2 in small words. What do we write here? There is a detection risk that the audit team may not be able to identify misstatements within the financial statements. In simple words, we have explained that. Now, when I come towards the third step, we had to mention which accounting treatment, or what does the accounting standard say about this situation, how something has to be recorded. When in the previous lecture as well, in the previous questions that we have done, we have discussed that there is no situation, there is no accounting standard that can be linked with these types of circumstances, because this is a detection risk. This is not a risk within the financial statements. So you can simply skip out this. The examiner will not deduct the marks for it. But now you will have to explain in your own words why the risk that you have created, why does it exist? Why does it exist? Why? You have to explain the reason for that. So what is the reason for the first risk that we have created? This one, that you will not be able to detect the misstatements within financial statements, because as an auditor, this is your first client, this is the first time you're auditing this company, which is why you don't have any kind of experience with this company, and you may not be able to identify the risky areas within financial statements, the risks, the misstatements within financial statement. So what have I written down here? The audit team does not have enough experience with this client, as it is a new client. Also, they don't have enough knowledge of the client, hence the above risk exists. This is why this risk is existing. So this was the third paragraph. Now, for this specific risk that we have created, what is the appropriate response in this case? By now you should remember it, that as an auditor, in order to reduce the detection risk, what can we do to reduce the detection risk? We can increase our number of samples, we can increase the quality of samples that we select, and we have to be more professionally skeptic. This means anything that the management gives to us, we should not directly rely upon those things, because this is a new air client. We don't know about the integrity of the management, whether they are honest or not. So they may try to manipulate a lot of the things within the financial statements, because they also know that we are a new auditor for this company, and the management can easily manipulate us. They may know that, and they may take advantage of it. So that is why, number one, increase the number of samples and also be more professionally skeptic. This is the appropriate response. So what is the response written here? The audit team should be made with more experienced team members, so that the misstatements identification will become easier for them. Additionally, the audit team should also be more professionally skeptic and select a higher number of samples to reduce the audit risk. For your exam as well, you can always write down this recommendation, this auditor's response for the audit team. Now, coming towards the second risk, I told you within the exam, you can only write down either one, either the first one, that the audit team has no experience, or either the second one, that the opening balances may be misstated because you were not the auditor previous year. You only have to write down one within the exam. The examiner will only give you marks for one thing. So the second risk is, in this case, there is a detection risk that the auditor may not be able to identify the manipulated figures in the opening balances of Knight Electronics Corporation. So this is basically the the paragraph number 2 that we have to write. What is the risk in this case? The risk is that there is a detection risk that the auditor may not be able to identify manipulated figures in the opening balances of Knight Electronics Corporation. Now, coming towards the fourth paragraph, which we have to write down, we have to explain in our own words why the risk that we have created exists. Number 3 is again not applicable here because this is not related to the financial statements. When some kind of a risk that you have identified is related to the financial statements, that is where this number 3 paragraph can only be written down. In other cases, where you are identifying a risk related to an auditor, where the risk is not within the financial statements, but in the work of an auditor, in those cases, you cannot write down the third number paragraph. You can only skip directly from 2 to paragraph number 4. So writing my answer down, why do I think that there is this risk? Why is this the case? The risk was because management knows that we as an auditor are the first year auditor and we may not be able to identify the manipulated opening balances within financial statements and we will not be able to trace them. Management may take advantage of it. So Hercules Corporation was not the auditor of Knight Electronics in the previous year. Hence, knowing this, management may manipulate the opening figures of the current year financial statements to show better closing figures in the year-end financial statements. And what is the appropriate response in this case? I told you, the response to check the opening balances within the current year financial statements has been and will always be an audit team should take the previous year audited financial statements, the finalized financial statements, and should compare the closing balances within the previous year financial statements with the current year financial statements opening balances. So, and I also made a diagram how previous year closing balances always affect the opening balances of the current year. So the response in this case is the audit team should first take the previous year audited financial statements and compare the closing balances of previous year financial statements with the current year opening balances, and if there is any kind of difference, then this should be discussed with the management and they should be told to correct these kinds of errors that have been identified when comparing both your financial statements. Moving back towards my question, let me highlight it that we have identified our risk number 1. How many risks did we have to write down? If you guys remember that correctly, we only had to write down 8 total risks. 8 total risks are the one that we have to write down. Now, first risk we have already identified. Let's try to identify more than 8. Moving back towards the question. Knight Electronics Corporation sells products enabling smart building systems which allow customers to efficiently control their security, lightning, and network needs. So basically, what is the business of this company? This is what we are being told right now. They basically provide electronics and security services to buildings that have already been built. So they install different kind of softwares like, let's say, Alexa, let's say door locks that can be controlled from anywhere in the world, and they provide these kinds of security services and networking needs as well. For example, internet services within the building as well. They provide that. This is their business. No risk can be identified in this case. The audit manager held a preliminary meeting. What is meant by preliminary? I told you when we were understanding from the lectures, from the notes, the clean notes, what is audit risk, how do you write down about audit risk, there was this word used within analytical procedures. Preliminary means planning, the other word for planning. So preliminary means a planning meeting was held. The audit manager held a planning meeting with the finance director and has provided you with the following notes. So these are now the remaining things which have been told to us, that what discussion was held between the audit manager and the finance director, and we are being told about that. We will have to identify the risky areas from within this discussion that the finance director and the audit manager had. Now, let's read forward. Since its launch 5 years ago, Knight Electronics Corporation has experienced high levels of growth, such that the founder and CEO William Knight is considering a stock exchange listing next year. So basically, this means that first of all, it's been 5 years since this company has been starting to do business. This company is 5 years old. But the CEO of the company, the name of the CEO is William Knight. The risk in this case is that they are right now considering that they want to be listed upon the stock exchange. And in order to be listed upon the stock exchange, if a company wants to list on the stock exchange, what would be the motivation of that company? What would be they motivated to do? They will automatically be motivated that we haven't right now been listed upon the stock exchange, but we will become listed. If they want to become listed upon the stock exchange, this means that they would want to sell their shares at a higher price. They would want to ensure that we get most amount of money from the investors of the stock exchange. This is what they would want to have. And how could they achieve it? By having higher revenue, showing more revenue, by having high profits, by having high number of assets, high value of assets, and also by having a low number of total liability figures, and also by having a low amount of expenses within financial statements. All of these things would ensure that they present a better financial image to you guys. You are the investors within this company who will buy the shares of this company. And if you see that this company has a very good financial image, you would want to pay more for the shares of this company. So essentially, the company right now would automatically be motivated to show a better financial image and to manipulate the financial statements as well, so that the financial statements show a better financial image. Even though, let's say, the company is making a high amount of profit, let's say their profit is 1 billion, they would still want to make it more high. They would want to have a profit of 1.5 billion or $2 billion. Why? Because that would ensure that they would get a high price within the market. So right now they are more manipulated, they are more motivated to manipulate the figures in the financial statements to show a better financial image of the company. So coming towards our answer, we will always follow these 4 steps whenever we identify the risky areas within financial statements. Step number 1, explaining this risk in our own words. So by explaining the risk in our own words, this is what I have done, written. See, the CEO of the company is considering to list the company in the stock exchange. This is the step number 1. Step number 2, what is at risk here? Where is the risk of overstatement or understatement? In this specific case, there is no risk of over or understatement. The risk is that the whole financial statements will be manipulated. This means we don't know whether something will be overstated or understated, but we know that it will be misstated within the whole financial statements now have a risk of misstatement. So my paragraph number 2, according to how I have told you how the risks should be written down, is there is an overall risk that the financial statements as a whole would be misstated. Now moving towards paragraph number 3, again, there is no one accounting standard or accounting treatment that can be linked with the whole financial statements. If we want to mention an accounting standard, then we will have to mention all of the accounting standards. Why? Because every accounting standard is linked with one separate financial line item and it would become really clustered. So we can simply skip this out because this is a general risk. When we talk about a specific risk that we have identified within financial statements, specific risk means that one separate financial line item or line item within financial statements would be misstated, over or understated. In there, we can always write down paragraph number 3. But in a situation where we are trying to create a general risk related to all of the financial statements, every single line item, then we cannot simply state a single accounting treatment in that case. So we can simply skip the point number 3. Let's move towards the paragraph number 4, where now we have to explain why does this risk exist. We have explained that there is an overall risk that the whole financial statements would be misstated. Now, why is this the case? Why, as an auditor, as an audit manager or a supervisor, I'm thinking that there would be this risk within the financial statements? Why? I have to explain it. I read within the question that they are trying to become a listed company upon the stock exchange. They will be motivated to manipulate the financial statements, which would now have a lot of misstatements, to have a better financial image of the company. This is why I created this risk. Let's read what I've written here. The CEO of the company would want to get a highest price during the listing for the shares of the company, which is only possible if revenue, assets, liabilities, and expenses of the company would present a better financial image of the company. And to achieve these, the CEO and the directors of the company may misstate these figures in the financial statements, hence the above mentioned risk exists. This is the reason why the above mentioned risk is existing. Now, what is the appropriate response in this case? I told you that the appropriate response again in a generic risk is to be send an overall experienced audit team, increase the number of samples, and also you can do this, that you can be more professionally skeptic, you can test more things. So the overall detection risk in this case as well is reduced. Coming towards my answer, the audit team should be more professionally skeptic during the audit and should reduce the overall risk by selecting increased number of samples so that the mentioned risk can be identified. I told you within the lectures as well, I am repeating this again and again, I know that higher the ROMM, risk of material misstatement within financial statements, then the auditor will have to reduce the detection risk. The detection risk is something that is controlled by the auditor. It is controlled by auditor. And how can an auditor increase or reduce the detection risk? By selecting a low number of samples or a high number of samples. In this case, this is the ROMM. The risk of misstatements within financial statements is very high in this case. So the auditor now will have to reduce the detection risk. How? By selecting more samples and becoming more professionally skeptic during the audit. Do not trust anything during the audit. This means more professionally skeptic. Testing out more things, testing a huge number of samples during the audit. This means you are reducing the detection risk. Now, moving towards the next ones. First, let me highlight this one. This is the second risk that we have identified from within the question. So this is the second risk which we have identified. Now let's move towards the remaining question and let's try to identify more risk. Let's read it. Knight Electronics Corporation has both corporate and domestic customers. By corporate, we mean customers who buy in a huge quantity from us, and by domestic, we mean people like you and me who buy stuff, security things, Alexa and door locks for our own home. So individual customers are known as domestic customers. Corporate customers are known as buildings and so on and so forth, which do not just buy one security lock for one door. They would buy thousands of different security locks for all the buildings. So bulk purchases versus one single purchase. On 1st of October 2014, what was the start of the year of this company? It was 1st of July. So this falls within our year end. On 1st October 2014, Knight Electronics Corporation began to offer customers the option to purchase a 3-year servicing agreement. This provides 3 annual services for products purchased. Customers pay for the servicing agreement in full at the start of the agreement. Okay, so what is happening in this situation is that we, before the start of the year, not before the start of the year, during the year, Knight Corporation, the company that we are auditing at the moment, they introduced a new service for their customers. What they would do is that they would sell a 3-year servicing agreement. So I agreed with my customers that I will provide you a 3-year of service, and this service will include after sales services, like let's say one of your door locks is not working properly, I would come to you and replace the door locks, and whatever is not working properly which you have bought from us, I would come to your office, I would come to your building and replace it, correct it, to ensure that everything is working appropriately. I would always come after 1 month to just check everything is working appropriately or not. So for 3 years I will continue to do it, and for these 3 years of services, my customers agreed with me that whatever amount is agreed for all of these 3 years, I will pay that in advance. At the date I agree with you that I want to buy this service from you, I'll pay you all of the money. And then for the next 3 years, my company that I'm auditing, Knight Corporation, they will have to provide a service for 3 consecutive years. It is the same as, let's say you want to buy a car. With that car, you also get a 5 years maintenance services. At the start of buying the car, you pay all the amount as an advance, but you still get services after 5 consecutive years. If you go to a showroom to buy a BMW or Mercedes or Corolla or Honda, you always get a 5-year service agreement. What is that 5-year service agreement? That the Honda, Corolla showrooms, wherever you go to them for maintenance of your car, for oil changes and so on and so forth, it would be done for you for free. This specifically means that advance has been paid against all of the services that will be received in the future. The risk in this case, what is the risk in this case? The risk in this case is that you have received from your customers all of the payment in advance. All of the payment has been received from your customers in advance. Okay, that is a good thing. There is a risk that all of this amount that has been received, you might have recorded that as a revenue. Why? Because this is a very complex accounting treatment. We know that IFRS 15, in this case, IFRS 15 states that revenue can only be recorded when a performance obligation has been satisfied by you. And your customer is also satisfied that whatever you had to do for them has been done for them. So for a 3-year agreement, what should be the accounting treatment in this case? Let's say year 1 has passed. For 1 year, let's say you received $30,000 in advance for all the 3 years. You received $30,000 for all of this 3 year from your customer. You received $30,000. Let me write it down. This means if 1 year of service has been provided, only $10,000 can be recorded as revenue. The remaining $20,000 cannot yet be recorded as revenue. Am I correct or not? Yes. If I pay you $30,000 and you have to provide me service for the next consecutive 3 years, this means for the first year of the financial statements, the first year that the financial statements are prepared, you can record the revenue for only 1 year. But for the next 2 years, right now, you cannot record the revenue because for the next 2 years, the service has yet to be provided. You have to provide a service to them. This means that this is a liability. $20,000 is a liability, only $10,000 is revenue. What would be the double entry in this case? Let me write down a double entry for you so that you guys can understand. Advanced received. Let me give the heading of advanced received. So let's say your customer paid you 30,000 US dollars for a service that has to be provided for 3 years, and the customer has paid you in advance, and you will provide them a service for the next 3 years. This means that if 1 year has passed, first year has passed, you can only record a revenue divided by 3 is equal to $10,000 is the only revenue that can be recorded at the end of the year, not at the start of the year, because revenue can only be recorded once the performance obligation is satisfied. So for the first year, the performance obligation has been satisfied. You can record this as a revenue. At the start of the year, when you received cash from the company, once you received cash from your customers, what would be the debit entry? So you received cash, so debit the cash by $30,000. Right now, you cannot record it as revenue. You cannot do credit revenue by $30,000. This would be the incorrect entry. This wouldn't be correct because right now performance obligation hasn't been satisfied by yourself. You have to satisfy the performance obligation first. And if you haven't done it, then obviously you have to post a second entry. Where would this be posted? Right now, you have to provide this service. You are liable to your customer that you will provide a service for an amount of $30,000. So this is your liability. So I know that I have to credit a liability by $30,000. But which specific liability would be credited? This is known as a contract liability. Contract liability. Whenever cash has been received by you from your customer, the service or the product is not delivered yet, you haven't satisfied the performance obligation. The thing you credit in that time, credit during that time when you have received the cash, you haven't provided the service to your customer, you haven't given the product to your customer, this is known as a contract liability. That according to the contract made with the customer, you are right now liable to provide this service to your customer. Now, let's say first year has passed. The first year of the company has passed. You can record a $10,000 of revenue. Now, this means $30,000 of contract liability within statement of financial position is already recorded. You only need to take that amount that you can record as revenue, that is $10,000, and record it as revenue. So first you need to reduce the contract liability. To increase the contract liability, you recorded it at the credit side. Now let's reduce it. Debit your contract liability by 10,000. This entry, whenever it's made, this would reduce the amount of the contract liability to 20,000. Automatically now within your financial statements, in the statement of financial position, your contract liability would be at $20,000. And then you would also credit your revenue as $10,000. This means that during the year, only $10,000 of the $30,000 that was received is recorded as revenue. The remaining $20,000 is still recorded as a contract liability within the statement of financial position. Now why did I tell you all of this? Because if any one of you has confusion, what would we do with the amount? Where would it be recorded if not as revenue? What is contract liability? From now onwards, you will not have this confusion. What is a contract liability? You know, a contract liability is anything where you have received the cash from the customers, but you haven't provided the service or haven't delivered the product, you record it as a contract liability. Because according to the contract made with the customer, right now you are liable to provide them the service of this amount. But the risk in this case, what is the risk in this case? The risk is that management, as an auditor, always remember, as an auditor, my job in the planning stage, in the audit risk question, is to make sure that I identify every single area within financial statements where management may have done something wrong. So the risk in this case is the management may have recorded all of the amount that was received at the start of this agreement as revenue. They have not recorded any kind of contract liability because this is a very complex calculation. As an accountant, you have recently studied F7 and still you guys don't remember what is a contract liability. So how can you expect the management to remember what is contract liability when it's been 20 years for their accountants who have qualified ACCA, who are qualified chartered accountants? It's been 20 years for them. As an accountant, as a student who has recently passed F7, you don't even remember it. So how can you expect the management would remember it? There is a risk that they would not have made this calculation because this is easy to forget, because this is a very complex calculation, and they may have recorded all of the amount as revenue. This is the third number of risk that we have identified. Moving towards my answer sheet, I have written it down. First of all, now coming back to words, the way I will solve it. First, I have to explain in my own words identification of the risk, explanation in my own words from the scenario. Like, what am I going to create a risk about right now? Knight Corporation is introduced for their customers to purchase 3-year service agreement, and the customers have to pay in advance. Just a simple identification has been done to let the examiner know this is the situation about which I'm going to create a risk in next few paragraphs. So the next paragraph was specifically after I have understood what is the risk in this case. Now I have to explain. In the next paragraph, I have to explain what are the things which have a risk of overstatement or understatement. In this case, the risk is that management would have recorded all of this as revenue, whereas it shouldn't have done that. So revenue is at the risk of overstatement. They should have recorded all of it as a contract liability. They may not have done that. So contract liability is at the risk of understatement. So let's explain it now. Let's write it down how you would write it down within the exam. There is a risk that the revenue within statement of profit and loss will be overstated, and in the statement of financial position, the contract liability understated. So I've explained which specific items within the financial statements are at the risk of over or understatement. Within the next point, I have to explain a particular accounting statement or an accounting standard that deals with this specific situation. I know that IFRS 15 states that revenue can only be recorded once the service has been provided. This means, what is the proper line to use in this case? Accounting standard states that revenue can only be recorded once the performance obligation has been satisfied by the company. So this is what I would write down within my answer as well. This is the paragraph number 3. According to the accounting standards, revenue can only be recognized if the performance obligation is satisfied. If not, apologies for the wrong spellings. If not, then a contract liability should be recorded. So this is my paragraph number 3, which I have written down here. So up till now, I've perfectly done all the explanations that I have to do. Now coming towards paragraph number 4, I have to explain in my own words the risk that I have created, that revenue will be overstated and contract liability will be understated. Why? I have to now link this standard with this risk and explain in my own words that why management would have done this. Let's explain it. I have written down the above risk exists because the management may have recorded the full amount received in advance as revenue, but still the service is not fully provided. Hence, this should not have been recorded as a revenue. And the risk is that the management would have done it. So I don't need to write every single thing down. Obviously, I have explained the risk here. So I just need to explain why does this risk exist. Now let's come towards the recommendation. What do you think would be the recommendation, an appropriate recommendation in this case? Has the management done it? Am I sure the management has done it? Obviously no. So the first thing I should do is that, shouldn't I discuss with someone from within the company, what accounting treatment did you use for this advance that you received? What accounting treatment did you use for the advance that you received from your customers to whom that you will be providing to this 3-year services to? So first, I should ask from the management themselves, what have you done regarding this? What double entry did you make regarding this? Let's discuss it. I will let the audit team know. First, you have to discuss it. The audit team should first discuss with the management about what accounting treatment has been performed by the management to record the advance received. This is the first thing that the audit team will do. But I know that I should not simply rely upon the explanations that are given by the management. This means that I will have to test something out as well. I will have to test something in detail as well, testing in detail. What is the appropriate test that I can do? Can I ask for a breakup and check the actual evidence? Can I calculate and compare? Can I physically check something? Obviously, I can't physically check anything out because revenue is not physical. Can I verify some kind of a payment from the bank? Many of the students would say, why, sir? Why can't we simply verify the payment that we have received in advance and we will check whether we have received it or not? Does it satisfy the risk that we have created? The risk is that we are stating management may have recorded it as revenue. We are not creating a risk whether we have received an advance from the customers or not. We are not creating this risk. We are creating the risk that management may have recorded this as revenue. Has management recorded this as revenue or not? That is the risk here. We need to perform some kind of a test which verifies that has this been recorded in revenue or contract liability. We need that kind of a test. This wouldn't verify it. Can we compare with the previous year? No. Analytical procedures can only be performed, and this obviously should be the last resort. I've always told you that. You can't compare every single thing out. What we can do is that we can tell the management to provide us a breakup. Now, many of you might think that, sir, we can ask for the total breakup of revenue total breakup of revenue, all of the revenue that has been recorded by the management, and we can let the management know, please give us invoices, and on a sample basis, we can test these invoices out. No, that would be the inappropriate way to write it down. The appropriate recommendation to the audit team would be, I can tell them, you can ask the management to give you all the new contracts that they have had during the year, all the new contracts that the management has made regarding this new service. Then you can trace those contracts, that the receipts that were received, the cash that was received from the customers, where has the management recorded it? And if anything has been recorded within revenue, then this should be discussed with management that they have to record it as a contract liability, not as a as revenue. They cannot record it as revenue. So instead of asking for breakup, I am simply, breakup of revenue cannot be asked. I can ask the management to give me all of the contracts, that the new contracts that they had with their customers regarding this new service that they are about to provide. So the next recommendation I have written down, the audit team should also select a sample of new contracts and test them through financial statements as to whether these have been recorded as revenue or contract liability. If revenue has been recorded, then this should be discussed with management that this has to be reversed. So testing through the financial statements means that you are tracing a simple transaction through the financial statements. This means what double entry was made, in which areas of the financial statements was that double entry impacting the financial statements. So this means that you are basically tracing a transaction that has been recorded by the management. This is what this lines means. Test them through the financial statements to identify where has the management recorded these transactions that have been done. If they are recorded in the correct place, well done by the management. They know about contract liability. If they haven't done that, then they have done something wrong, and they have to correct it. Moving towards the next identification criteria right now, let's move towards identifying more risks from this question. Let's read forward. Component parts are purchased from a number of suppliers. Obviously, now, in order to provide services to their customers, they need inventory. Like, for example, door locks, security locks, pin locks, connected with a system which can be controlled from anywhere around the world, a network it can be connected to. All of these things are not made by this company. They don't have a factory or somewhere, an established factory within their country where they make these things. No, they don't do that. What is written here is that they are purchased from different number of suppliers. They are purchased from many different suppliers. And then the company sells these components with the services that they offer. Good. So component parts are purchased from a number of suppliers. Great. Prices of components have been steadily increasing over the past 2 years, leading to a reduction in the gross profit margin. Okay, so the risk in this case. Now, this line also creates a risk for me. What is the risk in this case? Whenever you see that the gross profit margin of the company, how is gross profit calculated? Gross profit divided by revenue multiplied by 100 is gross profit margin. Whenever you see that the gross profit margin of the company is decreasing significantly, this means, let's say the gross profit margin was 18% in the previous year, this year is only 2%. That is a very big, significant amount of decrease. This always means that maybe the prices of inventory year on year are increasing, whereas the management is still selling them at the same price. Let me give you an example for this. Let's suppose inventory prices. Let's make a financial statement for just one product, one item that you sell. You sell something for $20. This was the revenue. This was the sale price. This means this was the revenue. And when we come towards cost of sales, you purchased it for $10. So whenever you are selling something, the purchase price of those things always goes towards cost of sales. This is how gross profit is calculated. GP is 20 minus 10 is equal to $10 of gross profit. Here, the gross profit margin would be 10 divided by 20 multiplied by 100, 50% margin. So it is a good margin. This was the previous year. Now, let's suppose, let me write revenue, the heading revenue, let me write it down first of all. Let's write down cost of sales, the total, the gross profit, and then here we will calculate the margin. Let's suppose this year the cost of these socks that you used to sell, right now you used to buy them from your suppliers, and this year as well you buy them from your suppliers. You don't make your socks, you just sell them. You have a very good brand and customers are ready to buy it from you. But this year your supplier said that we will only sell it to you for $15, otherwise we can't sell it to you. Our cost has increased too much. So you bought it from them for $15. But in the market still you are selling it for $20. Now your gross profit would be $5. If you compare it, and now if you want to calculate the margin, it would be 25%. This means that the cost of inventory year on year has increased, whereas your sales price is still the same, because of which your margin has reduced by so much. As you compare to the previous year the margin was 50%, this year the margin is 25%. This specifically shows that your customers, you are very afraid to sell your customers at more than $20. Your customers will not buy from you if you increase the price more than $20. That is why you are not willing to increase your sales price. And the risk in this case is always, because now understand, this was just one product, one item that for which we made the financial statements. When we talk about companies, there are thousands of different items that they sell every single year, thousands of different products that they sell every year. We are not able to identify, even if the margin is decreasing but still they are making a profit. This means that still the sales price is more than the cost of this inventory item. But there might be some items within inventory which have a higher cost. You would have recognized this within inventory at $15, but you would be only selling it at $14, or let's say $14.5. This means the cost of the inventory is right now more, whereas there is a chance that the NRV might have decreased within the market or would decrease in the future. Then there is always a risk that the inventory might be overstated. It might still be recorded at cost, whereas the management should have compared it with NRV, whether the NRV has been decreased and is lower than the cost of the that inventory item, because IS2 specifically states that inventory should be recorded at the lower of cost or NRV, and management might not have recorded at the lower of either of these two things. The NRV might be lower than the cost. So the risk in this case is, again, if I move forward and read it just in front of you, the forecast financial statements for the year ending 30th of September 2015 show inventory is valued at cost. So the management is valuing the inventory at cost. The risk in this case is that the NRV might have decreased, because of which the inventory should be written at the lower of which is NRV, and the management might not have done that, because of which this means that inventory is right now overstated and the relevant expense. When you have to write down inventory at NRV, where would the difference go? The difference would go within statement of profit and loss as an expense. Inventory value decrease due to writing it at NRV. Management has not done that, because of which the inventory is overstated and that expense is not recorded, hence that is also understated. Moving towards my answer sheet, how have I written it down? Let's read it. First of all, the first paragraph is always for identification. How have I identified it? Explaining from the scenario about what you're about to write down. The prices of the component parts have increasing over the past 2 years, because of which the gross profit margin of the company has also decreased and the inventory is valued at cost. So this is simple identification from the scenario that is given to us. In paragraph number 2, we always explain what financial line items are at the risk of over or understatement. Here the inventory is at the risk of overstatement and the relevant expense is at the risk of understatement. It is written down here within paragraph number 2. In paragraph number 3, we always mention what is the correct accounting treatment related to this situation. The correct accounting treatment is that inventory should be valued at the lower of cost or NRV, which is written in paragraph number 3. Now, within the 4th paragraph, I have to explain in my own words, why does this risk exist? Why have I made this risk? Why? What was I thinking because of which I created this risk? I was thinking that the NRV might have reduced because the inventory is still being valued at cost, whereas the cost of inventory is growing up, but the revenue of the company is still going at the same pace, because of which the gross profit margin has gone down, which shows that the NRV might have reduced in the market, because the price at which you are selling something at, it is not increasing. So that is my basic thinking behind creating this risk. Let's write it down. How would I write it down within my exam? The decreasing margins suggest that although the cost of components have increased, but still the company is selling these at the old prices, which are not increased. This creates the risk that the older price of NR, sorry, apologies here, I have to write down that the inventory is at, so, continuing, this creates a risk that the inventory is at older price, the NRV of the components may be lower than the cost of these items, which created the above risk that the management might not have recorded them at NRV. So, what can we do? What can an auditor do in this case? What is the appropriate response in this case which an auditor can do? Can we discuss with the management? Obviously, no. Discussing with management is not going to let us know whether there is a risk or not. In this case, we will never know. Yes, we can discuss with the management and ask them, have you recorded them? Have you calculated their NRV or not? We can discuss. But let's talk about testing in detail. Always move towards testing in detail whenever it is something linked to the financial statements. What we can do is that we as an auditor can ourselves create or calculate the NRV of these items and check with the cost at which these items are recorded at within statement of financial position, and then compare them. And if the NRV is lower than the cost, we can tell the management that, you have done some things wrong here as well. Within the financial statements, you should have recorded them NRV, but this is not the case. So what we can do is we can calculate and compare. What can we ask the management in this? That what do you, obviously as an auditor to calculate it, some of the things, I will need some of the things from the management. So what I can do is that I can ask the management to give me an evidence first of all. First, give me an evidence. I will ask the management first, please give me an evidence. Evidence of what? What was the most recent price at which this item was sold at? So maybe show me an invoice. I will let the management know, can you show me an invoice, the most recent invoice within this year at which price this item was sold at? Then I can, using that price, I can calculate the NRV of this product and compare the NRV with the cost at which in the financial statements, this item is recorded at the cost. And then compare it. By comparison, I will automatically know, as an audit team member, I will know whether the management has recorded at the correct amount or not. Because if the NRV is lower than the cost, this means the inventory is overstated. How have I written it down? The audit team should obtain a sample of these components and identify the cost of these samples. First of all, you have to identify what are these items recorded at now and compare with the current selling price. If the recalculated NRV is below the cost, then it should be discussed with management that these items have to be recorded at their NRV and any differences taken to the profit and loss. So if there is a difference between NRV and the cost, you will have to record it as an expense within statement of profit and loss. So this is the appropriate response in this case. Always try to create a response out of test in detail. Whenever something is linked with the financial statement, always try to create a response from the test in detail. Always try to create a response out of this. Never try to create a response directly from management inquiry or correspondence. These can be used, but these are used in separate situations, which you should have identified by now. So, how did I create this response? I thought, where can I get the current price of these items at which they are being sold at? Obviously, I can't get it from the financial statements. Financial statements have a total price. Then I thought, what if I ask the management to give me an invoice which have price of these items? And that is how I created this response for my audit team. Moving towards the next part now. How many risks have we identified? We have already identified 4 risks. So now we only need to identify 4 more. Let's read it. In June 2015, Knight Electronics Corporation decided to revalue its premises. So during the year, they have done revaluation. Automatically, I will know that the revaluation amount that they may have used may not be correct. So I know the default risk in my mind, and this is the same risk that we created within the previous question as well, which had previously been accounted for using the historic cost model. Properties with a carrying amount under the cost model of 3.8 million. So this was the carrying amount, were revalued to 8.4 million. Such a huge revaluation has been done based upon a valuation performed by management. So management themselves did the calculation. Management themselves identified what is the current market price of the assets that we own, the properties that we own, and then revalued it. You need to remember the case that this same management is also motivated to present a better financial image of the company, and they may try to manipulate the assets as well, manipulate the figures in the financial statements as well, because they are about to become listed. They have this motivation that we need to manipulate the financial statements. So they may have done this huge revaluation at such a huge amount, from 3.8 billion to 8.4 million dollars. They may have done this to manipulate these figures. So there is automatically a risk in this case of revaluation. So the revaluation risk is always, first, I'll explain it in my own words. Second, the assets revalued may be overstated. And where does the revaluation gain go? It goes into the OCI, other comprehensive income. So that revaluation gain with an OCI might also be overstated. Management may have recorded an overvalued amount. This might not be the actual value in the market right now. Explaining this from the standard, the third step was to explain it. Apologies, give me a second, please. So the third one would contain that the management may have, what does the accounting standard say about it? The accounting standard states that the properties should be revalued at the amount of the most similar item within the market. You shouldn't revalue it just because you think that this should be the amount. No, you should choose the amount of the similar type of asset or property within the market, and then you should use that value to revalue your properties. And why do I think the management would have created this risk? Because management itself is right now so much motivated to manipulate these figures within financial statements, and because of this manipulation motivation that the management has, they may try to misstate the or overstate the figures to show a better financial image of the company. So reading it, the first paragraph, identification, is simply, in my own words, written down in the student's own words, from the scenario towards the question. In the second paragraph, I have identified which specific items are at the risk of overstatement. Overstatement is for the properties, and which other item is that the OCI, gain recorded within OCI, will also be overstated. Now, within the third paragraph, I've written down that the accounting standard states that the revalued amount has to be the value of a similar type of asset from the market. It cannot be a different asset. This is the appropriate accounting standard in this case. Why did I create this risk? This is the fourth paragraph, in which I have written down, as a student, I have written down that the management may have recorded such a high valuation in order to present a better picture of the assets due to goals of becoming listed, and may have selected incorrect amount to revalue these assets, because of which the above risk exists. What is the appropriate recommendation that I will give to the audit team in this case? What would be the auditor's response? How will the audit team test it out that whatever risk I'm thinking as an audit manager, would this risk actually exist or not? Can you test it out? How will they test it out? So first, let's discuss with the management in this case as well. How did they identify this value from the market? What were the assumptions they used? What were the basic assumptions they used in trying to identify what type of a similar asset has to be used? So first, I've written the audit team should first discuss with the management that on what basis the assumptions the properties have been revalued. So what assumptions were you using as the management? I will ask them, as the auditor, I will ask the management, what were the basic assumptions you used to identify whether this value is being chosen correctly or not? And how did you choose the correct value? Please show me the assets as well. What similar type of assets did you choose from the market from which you identified this value? But again, I told you, whenever you have to discuss something with management, you always have to write a test of detail right down. You always have to write down the test of detail. So in this case, we can't have an evidence. As an auditor, we can't go to the market to test out whether the correct similar type of asset has been used by the management or not, to test out whether the properties which have been revalued by the management have been revalued at the correct amount or not. What is the appropriate evidence in this case? We don't have an appropriate evidence. What we can do is that the assumptions, what is meant by the word assumptions? Whenever you are doing something as a forecast, where judgment is used, where accounting standard doesn't let you know this is one thing that you have to do. Like accounting standard says that a property has to be depreciated every single year, but it doesn't say at which life. Life is something that the management will choose from there on. So revaluation, at what amount property should be revalued? No accounting standard tell you that. The accounting standard only tells you it should be chosen for a similar type of asset. What is a similar type of asset? The accounting standard doesn't tell you that. So here the management has to use their judgment. Whenever someone is using their judgment, they have to make their decisions on a number of assumptions. What if we ask the management, what assumptions did you use, and we test out these assumptions, whether the assumptions used by the management during the revaluation were correct or not? Let me give you an example of assumptions. Let's say if a bank asks a company, prepare a 25-year forecasted financial statements for us. How would you prepare 25-year financial statements the years which haven't even started yet? You are in the present and you have to prepare financial statements for the next future 25-year financial statements. How would you do that? The first assumption you would use is that every single year there would be inflation and our revenue would also increase by inflation. This is known as an assumption that 10% inflation will be there every single year and our revenue every single year must increase by 25%. This is how you will increase your revenue. So in the current year, if the revenue is 1.8, you multiply it by 110%. Whatever answer you get is the revenue for the next year. Then for the next year as well, the next year's revenue would also be inflated against the revenue. This is how the companies prepare their forecasted financial statements. The same methods are used whenever you have to find out the value from the market. So assumptions means you assume that basically this asset for which the value of the asset that you are choosing, that asset is similar to your asset. This is an assumption of the management. Why don't we as an auditor test out these assumptions, whether these assumptions used by the management, are they even correct assumptions or not? So the next procedure or the next test in detail which I have written, the audit team should also test the assumptions used to identify revalued amount from the market. If the assumptions used by the management are incorrect, then it should be discussed with management that the revaluation is inappropriate. So whenever I write down this test in detail with an audit risk, that the assumptions of the management should be tested. This means I'm stating whatever management assumed during the revaluation process should all be tested by the auditors. And wherever the assumption of the management was incorrect, this means that they chose an incorrect amount from the market. This means that the revaluation amount is also incorrect. So this is the fifth number of risks which I have identified, which we as a class have identified from the scenario. Let's write it down. This is the fifth number of risk. Now let's move forward and try to identify more risks, because we have to identify total 8 risks. 3 more risks are still remaining. In May 2015, which falls within our year, defective equipment used by Knight Electronics Corporation resulted in a small fire at its premises. So basically, we were doing some of the things, let's say our operations were going on and suddenly a fire catch out. We found out that we were using defective equipment. We as Knight Corporation were not using right equipment. Defective equipment was being used. Now, the company has commenced legal action against the supplier of the equipment. Okay, so this equipment that we were using in our operations, in our business, this was sold to us by a supplier. That supplier sold us a defective equipment which was not right, which was either broken or damaged, which is why it caught on fire, and it caused us a lot of losses within the company. A simple fire can cause a lot of damage to the company. So we are right now taking a legal action against this supplier. So we went to the court and we made a case upon them that you have to pay us for all the damages. Whatever damage was caused during that fire, because fire was caused because of your defective equipment, this means that you have to pay us for all the damage that was caused to our warehouses and so on and so forth, to our buildings. Okay. Now, Knight Electronics Corporation's lawyers, the lawyers of Knight Electronic Corporation, the client that we are auditing, have advised that the legal action is likely to be successful. So the lawyers of my client, I am auditing Knight Corporation. So Knight Corporation's lawyer are telling me that we will be successful. We will win the case against our supplier and he will have to pay it to us. Okay. And as a result, the finance director has included a receivable for the damages likely to be received from the supplier in the forecast financial statement. So basically what has happened is that due to this fire, we had a lot of damage. Let's say a total of $200,000 worth of damage occurred. We lost our machines, we lost some of the people, we lost some premises. We will have to rebuild all of these things. And if in the case that this fire was caused by our supplier, this means that now our supplier will have to pay us this amount. This is the total amount of damage that occurred. The lawyers of my company have said that we will win the case. Don't worry about it. If we are sure, if it is virtually certain about a provision receivable that it will be received, then you can record it as a receivable. If you remember that specific table, let me create that table first of all. Provisions table. So if you remember this table, what was this table? This table used to say that when we talk about a liability and when we talk about an asset that has to be received from someone, receivable or payable, that has to be paid to someone or received from someone, when it is virtually certain, virtually certain, probable, possible, remote. The same here, virtually certain, probable, possible, remote. These are the chances of it happening. Whenever we have a liability, that is virtually certain that we will have to pay it, it is sure shot that we will have to pay it, we always record it as a liability. That is always recorded. Whenever we have a situation where it is probable that it is more than 80% chances that we will have to pay it, we are sure of it, but still not virtually certain, this means that again you have to record it as a liability, as a provision within the financial statements. Whenever it is only possible, wherever it is only possible, this means not probable, still possible that you may have to pay it, then it is not recorded as a liability. Rather, this is only disclosed within the financial statements. And what is the disclosure? That it is possible that we may have to pay in the future $1 million or $2 million because we had a fight with our supplier, whatever the case is. When we have a situation in which there are remote chances, very less chances that we will have to pay it, where we are saying basically, we will not really have to pay anything. This means that you only have to disclose it again. You only have to disclose it. Now let's come towards an asset. When we talk about an asset and it is virtually certain that you will receive it, then you can record it as a receivable, as a asset, whatever the case is. You can record it. This is what basically, by the way, this is IS 37, the table within IS 37 provisions, contingent liabilities and contingent assets. Whenever it is only probable, wherever it is probable that you will have to pay it, that you may receive it or you will receive it, but it is not confirmed yet. This means that you cannot record it, you can only disclose it. In this situation, you can only disclose it. In the situations when we talk about an asset, when it is possible or remote chances that you will receive it, then you cannot record it, you cannot disclose it, you have to ignore it. You cannot do anything for it. Now let's talk about it again. Let's discuss it again. In the case of liabilities, when do you record a provision for which you are not confirmed yet whether you have to pay it, but somewhat it is confirmed? In the case of virtually certain and probable, you have to record them. You have to show it that it is a liability. But when we talk about an asset, only in the situation of virtually certain, it is sure shot that you will receive it. Only then you can record it. Only then it can be recorded. But in the case of probable, it cannot be recorded. It can only be disclosed. If you have a case against someone in the court, unless and until the court hasn't made the decision that you have won, how can you say that it is virtually certain that you will receive an asset? How? How can you state that it is virtually certain? It is only probable. Even if your lawyers are saying that no, we will win, it is only probable. In that case, you can only disclose it that we may receive this amount in the future. Still, it is not virtually certain unless and until the court has given a decision that yes, this company has won it. This company has won it. You cannot record it. In the case of liability, if the court hasn't given an opinion whether who has won it, still if it is probable that you may have to pay it, the court hasn't given a decision, but still it is probable that you will have to pay it, still you have to record it. But in the asset, this is not a case. In the asset, you cannot do it. In this situation, in this specific scenario, the management, even though the court hasn't given a decision, the lawyers are only saying that we will win this case, the court hasn't given a decision, still the finance director has recorded it as a receivable within financial statements. As an auditor, don't state that it might be probable. You may only need to disclose it. You cannot record it. Just ignore it. The fact is they have recorded it. They shouldn't have recorded it at the moment. There is a risk in this case as well that management has recorded this as a receivable, but they would not actually receive a payment, or according to the accounting standards, it is not virtually certain at the moment whether they will receive it or not, because the court hasn't made a decision as of yet. Then how can they record it? This is the risk in this case, which would mean that this receivable should not have been recorded. The risk is that this receivable should not have been recorded because it may not be virtually certain up till now. And this means that, what is the amount here? What the amount hasn't stated here? Okay, the amount hasn't been given to us. This means that this receivable that has been recorded by the management is overstated, and what would have been the other entry, an income within statement of profit and loss, that is also overstated. They would have debited receivable by whatever amount and credited income by the same amount. So this would mean that they have overstated both of the things. This is the risk in this case. Now, in order to answer this, obviously you will need to remember how we have identified these things. So this is the explanation. So the first paragraph, always you explain in your own words what is the thing that you're about to create the risk for. So I have written it down. Knight Corporation has recorded a receivable against their supplier for the damages which were caused by the supplier's components. In the second paragraph, you always write down what is at the risk of over or understatement. So the risk is here that this receivable which is recorded by the management is overstated. They shouldn't have recorded it, but they have recorded it. So it is written down here. There is a risk that these receivables recorded is overstated. Now, what does the accounting standard relate to it? What does the accounting standard has an accounting treatment related to this situation, that it can only be recorded, an asset can only be recorded if it is virtually certain. According to the accounting standards, an expected receivable can only be recorded only if it is virtually certain that the amount would be received. And why have I created this risk? Let's move towards that now. Why have I created this risk? Although the lawyers of Knight Corporation have advised that the amount will be received and Knight Corporation will be successful against their supplier, still the case may not be won by Knight and Corporation, and hence the amount may not be received, hence the above risk exists. In short, if the court hasn't given a decision, how can you say that it is virtually certain and you are recording that thing? Unless and until the court hasn't given a decision, even if it is probable that you will receive this payment from your supplier, still you cannot record it, you can only disclose it. Now, what should be the appropriate response in this case? Forget about the responses that I have not given to you. Forget about them. Try to create a response from yourself, from your own mind, from your own imagination. Try to create a response from your own imagination. First, why don't we discuss we cannot discuss this thing with the management. Why? Because management has been advised that you will win it from the lawyers. This advice has been given to the management from the lawyers. They have only acted upon the lawyers' advice, and that is why they have recorded it. They did not record it themselves. The lawyers are the one who said that you will win this case. So why don't we discuss this with the lawyers of this company? Upon what assumptions and what basis did you tell that the company will win this case? What were your assumptions? Please let us know. Let's discuss the assumptions that were used by you in telling the management that they will win this case. How did you come to this conclusion? I need to discuss it with you first. So the audit team should first discuss with the lawyers of the company how they have made the assumption that the case would be won by Knight and Corporation, and it is virtually certain that the amount would be received by the company. How did you make this assumption? First, let me know about this. Let's discuss with them. I will let my audit team know. Go discuss it with them. First, maybe during the discussion, they let you know of something because of which it is confirmed that they will win the case. Maybe they have an insider knowledge, whatever the case is. First, I will let the audit team know. Go discuss it with the lawyers of the company. Secondly, obviously, I wouldn't still rely upon the lawyers of the company. The company wants to manipulate the financial statements to show a better financial position. I know this. Although I'm discussing it with them, but still they are motivated to do these things. So I wouldn't simply rely upon it. I need to have another test in detail using which I can identify whether this thing done by the management, is it correct or not. Okay. So basically, what is the year end of this company? The year end of this company is, let me come here. What is the year end of the company? The year end is 30th of September 2015 or 20x5. That is written within the question, right? Now, whatever the situation is, the audit will go on for the next 3 months. This means that the audit will be completed October, November, December. 31st of December 20x5 is the date upon which the audit will be completed. This is expected. During these 3 months, if the case is won by the company, obviously, if the case is won by the company, They would receive a payment from their suppliers. The supplier has to pay to them, right? Why don't I check? Why don't I let my audit team know? I tell my audit team that you will be continuing to do the audit up till this period. So why not ask the management that during this period, please give you the bank statements. See what is written here within test of detail. I have written down a procedure, test of detail, which you can do for auditor's response. You can let the audit team know that they have to verify the payment from the bank statement. So if they have received a payment, this means that the case was won by the company. And how can we verify that? Simply, you can let the audit team know that please, during this year, during this period of 3 months, after the year end of the company, the financial statements have been made for this year. They have been given to you. You will be auditing them for the next 3 months. Your audit will be complete. Expected date would be 31st of December 2015. So during this period, this 3-month period, if the case is won, the management will have received a payment from this supplier. Yes or no? Obviously, yes. So in these 3 months, for these 3 months, ask the management to share you the bank statements and look at these bank statements. If a payment has been received from supplier, then it is completely fine. Then this means that the management actually won. So the payment was received after the year end. So in these year end financial statements, they will have to record a receivable. They can record a receivable, which shows that, which is also confirmed that after the year end, management received a payment during these 3 months. So even though payment was received in the next year, this year they can record a receivable. In these financial statements, they can record a receivable. So in my answers as well, if I go towards that, see what I have written here. Additionally, the audit team should also check the subsequent means after the year end after the year end bank statements, subsequent year bank statements, to identify whether the company has received the amount from the suppliers. So this will also confirm, can the receivable be recorded or not. Coming back towards my question, this is the which number of risk that we have identified? This is the sixth number of risk which I've identified. Yes, the sixth number of risk which we have identified from the question, from the scenario. But I'm not simply going to move towards the next part because we have missed something out. Let me show you what we have missed out. Let me show you what we have missed out. Here, we identified in the above paragraph, we identified that there was a risk that the revaluation done by the management was inappropriate. In the same paragraph, this was the fifth number of risk. In the same paragraph, there is another risk here, written here. See for yourself. I'm going to read it and try to identify the risk from this lecture. The finance director also carried out an extensive review of the non-current assets' lives and decided to extend the useful life of plant and equipment from 5 years to 8 years. So the finance director has increased the life of plant and machinery. For properties, they did a revaluation. From properties, they did revaluation. What is PPE? Property, plant, and equipment. So for properties, they did revaluation, they increased the amount of the property. For the plant and equipment, they increased the life of these assets from 5 years to 8 years. What would happen in this case? If the life of an asset is increased, what would happen in this case? Let's come towards the notes. If any kind of life of an asset is increased, let's say I had an asset of $50,000, I was depreciating up till today, I was depreciating upon 5 years. If I use this life, yearly depreciation would be $10,000. So my every single year I would have to record an expense within statement of profit and loss P&L of $10,000. This would reduce my profits by $10,000. And after every single year end, the value of the property, the closing value of the property after charging depreciation would be $40,000. We know this, but now see what happens when the life of an asset is increased. Let's suppose now the life has been changed to 10 years. Instead of 50,000, instead of using 5 years of life, I'll be using a 10 years of life. What would happen in this case? Every single year from now onwards, the expense would be $5,000. Try to calculate it yourself. 50,000 divided by 10, $5,000 of an expense. This would go within profit and loss. Compared with $10,000 to $5,000, the profit would be higher in these financial statements. And what would be the closing value of the assets here? It would be $45,000, because 45,000 minus 5,000 would be 50,000 minus 5,000 would be $45,000 of an expense of the closing value of the asset. 5,000 would be expense. The profits have increased of the company and the assets of the company have also increased. This is how management tries to manipulate the financial statements every single year. This is what you also face within your practical life as well. This is known as this is known as cooking the books. This is known as manipulating the financial statements. So the risk in this case is that this second risk which we have identified is that management has increased the life of the asset to reduce the overall depreciation expense and to increase the value of the assets so that they can present a better image of the financial statements. What is at the risk of over or understatement? Due to increase of the life of the asset from 5 to 8 years, the overall closing value of the assets would increase. So assets might be overstated within statement of financial position, whereas depreciation expense might be understated within the statement of profit and loss. Although standards allow that a life of an asset can be changed, it can be reduced, it can also be increased. It is allowed under the standard. Nowhere any kind of standard says that a life of an asset cannot be changed. It can be changed. Some of the times what happens is that you may think that we bought this car to use for 5 years. You were first depreciating this car for 5 years and suddenly you identified that no, we will not replace this car after 5 years. We will replace it after 10 years. So now you would change the depreciation life from 5 to 10 years. It is completely allowed. You might buy a machine first and identify that the life right now is 10 years. But later on, during the use of the machine, you may identify this is a very good quality machine. We will not change this machine, replace, sell it in the market in the next 10 years. No, we won't do that. We will sell it after 20 years. This machine is very good to use for the next 20 years or 25 years. You can then increase the life of the asset because the standard says that the useful life of an asset should represent the life upon which that asset would actually be used within the company. That asset would be used by the company and will not be replaced before that. So that is the useful life of the asset. So as that is the case, it is allowed, but the risk is management may only have changed this life to increase the assets, increase the profits of the company, reduce the expenses of the company. So this is the risk which has been written down by me as a student. Let's read it. The first paragraph is simple identification. I don't need to read it. You can read it yourself after the lecture. But this first paragraph is simple identification from the scenario. Within the next paragraph, I have written down what specific items are at the risk of over or understatement. Property, the plant and machinery are at the risk of overstatement. They might be over recorded by the company because the life has been changed. And the depreciation expense is at the risk of understatement. Now, coming towards the next paragraph, what does the accounting standard say about it? Accounting standard states that the life of the asset should be based upon which the asset would be actually used, and the life should not exceed the use of the asset. If you will only use this asset for 10 years, you cannot use the life of 20 years then. So that is the same thing it is written. According to the accounting standards, the life upon which an asset is depreciated should represent its useful life and should not exceed it. Now, why did I create this risk? As I've already explained, that the management is already motivated to manipulate the financial statements because of the listing. They might have increased the life of these assets more than they would actually use these assets for, and because in order to present a better financial image of the assets and profits of the company. The finance director may have increased the useful life of plant and machinery so that the depreciation expense is reduced and the assets is increased. This would also mean that the profits of the company would also increase. This might have been done as the company is motivated to show a better financial image of the company. Hence, the above mentioned risk exists. This risk that we have mentioned right here, this is the reason because of which the risk exists. So what should be the appropriate auditor's response in this case? The first response is that management is the one who has decided that we want to change the useful life. Let's first discuss, as auditor of the company, we don't know why the management has changed it. First, we need to get an understanding from the management. Why did you change it, bro? Why? What was the reason behind it? Let us know the reason. As an auditor, if you can't give us a reason, this means you manipulated. So let's discuss it with the management. What is the specific reason? Why did they increase the useful life of the asset? Let's write it down. The audit team should first discuss with the management that on what basis and assumptions this increase in life decision has been made. This is the first thing. But obviously the management, if you go ask a thief that did you steal something, would they agree with you? Obviously no. Obviously they would say, nah, I did not steal it. But still you have, as a courtesy, you still have to go and ask the thief, did you steal this? They would obviously say no. But what other things can you do to identify whether they steal it or not? Would you rely upon that thief? Obviously no, you wouldn't do that. What you can do is that check the security cameras, check the CCTV, or check something else, ask from someone, was he the person who stole? You would still do some other things as well. This means test in detail must be always done in these types of situations. What is the appropriate test of detail in this case? Although I've written it down, but let's discuss it. Let's try to make a test of detail. Why don't you identify whether if the life of this asset has increased from 5 to 8 years, is the management also planning to use this asset for 8 years as well or no? Maybe if that is the case, if the asset can be used for 8 years, this means that the life increase is good to go, like there is no issue in that. But if you find out from the market or from somewhere that these assets cannot work after 5 years, that the management will have to replace these assets after 5 years, they won't be able to use that, the asset would not be usable anymore. If you find this out from someone, this would mean that there is an issue now. Secondly, the thing is, how old is this company? The age of this company is also 5 years. It was mentioned within the question as well that this company is also 5 years old. The business was started 5 years ago. So all of their plant and equipment was also bought 5 years ago. It already has been 5 years since they have been using this plant and machinery. If during the audit, during these 3 months that the company will be audited, if during these 3 months you identify that the company is selling these items and buying new property, new plant and equipment, this means this increase in life was manipulated. If they are still using the same assets in these 3 months, this means that okay, they continue to use these assets for the next 3 years as well. This means that the 8-year life will be good because it's already been 5 years since the company has bought these plants and equipment, plus 3 would be 8. So 8 years would mean that the 8 years life is good. So you need to verify whether management is using these assets for during these audit period as well. During this audit period, is the management still using these assets? What I have written down is that, see, the audit team should also test the assumptions used to increase the life of the asset and should also test whether these assets are replaced after 5 years or 8 years to determine whether the increase in life is useful, is appropriate or not. Secondly, here I could have also written down are replaced after 5 years as this company is 5 years old, and if yes, then the useful life increase is not appropriate. So this means that the increase in useful life in that case is also not appropriate. All right. Now, if the management is replacing all of these assets during the time that you are also doing the audit, within the next year, the management is saying, I'm going to sell this car, I'm going to sell this equipment, this plant and machinery and so on and so forth. This means management basically did the recalculation change from 5 years to 8 years useful life. This was specifically done to manipulate the financial statements. This was not allowed under the standards. Now, moving forward towards my question, I've already identified 7 different types of risks. Only one more need to be identified to properly complete this question within the exam. Let's try to identify it. During the year, let's read forwards now. During the year, the company's credit controller was ill and was absent from work for 4 months. Due to staff shortages, no replacement credit controller was appointed, so there was no one. What is the job of the credit controller? I told you this within the previous lecture as well. The job of the credit controller is to contact the customers and let them know your time is up, please pay us. Otherwise, I'm going to come to your house with bouncers and I'm going to kick the hell out of you. You have to pay me my money back. So this is the job of the credit controller. And if he wasn't present, who was going to the customers, contacting them that your time is up, pay us the money, pay us the money? Who was telling the customers of the company this? No one was there. For 4 months, no replacement credit controller was also appointed. There was no one. Now, see the receivable days. The receivable collection period has increased from 45 to 75 days. The receivable days are increasing. Do you remember within the previous question as well that we attempted, there was the same type of risk in the previous question as well. Let me show it to you. There was the same type of risk within the previous question as well. This one, receivable day increase, which I've increased, which I explained in quite detail within the previous lecture. So the same is the risk here. The credit controller was not present. No one was there to perform credit controller responsibilities. The total receivable days has increased. If the receivable day have increased, this means you might have some old receivable balances which the customers may not pay. Against them, an allowance expense should be recorded, which reduces the receivables, and that allowance expense has to be recorded as an expense within statement of profit and loss. So the risk is overstatement of receivables and understatement of the allowance expense. Management would not have created that allowance expense. What does the standard say? That old receivables, against them an allowance must be recorded. So let's coming towards the question. This is the part. So first one, I have just explained it from the scenario, identified the risk from the scenario and written it down within my own words in small few sentences. The next one is where again I have explained what is at the risk of overstatement or understatement. There is a risk that receivable and statement of financial position are overstated and the allowances for receivable expenses is understated. Simple, direct explanation. Where is the risk in the financial line items within financial statements. The third paragraph was always to explain what does the accounting standard say for it. The accounting standard says for old receivables, allowances must be recorded. As per accounting standard for doubtful. Doubtful means customers who you think are doubtful, they may not pay you. Doubtful, who are the doubtful customers? The older customers who have old balances still remaining. Doubtful debts and allowance for receivable. For doubtful debts, an allowance should be created. Now, why did I create this risk? Simple, because the receivable days are increasing by so much, 45 to 75 days, and the credit controller wasn't also present. The above risk exists due to non-presence of the credit controller, and due to this, many customer payments are overdue, and these customers may be doubtful and may not pay back the company, because of which the above risk, this one is existing. Now, what is the appropriate response in this case? Always remember, whenever as an auditor you find a situation that receivables are doubtful, allowances might not be created, there is only one response, and that is test of detail. What test of detail? Ask the management to provide you a breakup of receivables age wise. How many days it has been or how many long it has been since the customer hasn't paid you. So let's say an age wise breakup would mean an age wise breakup. Age wise breakup. If I have to give you an example of that, this would mean that let's say total receivables are of $20,000 receivable recorded within the statement of financial position. If you ask the management to give you an age wise breakup, so this would mean it's been 30 days since a customer A hasn't paid us how much amount? $5,000. It's been 75 days since the customer B hasn't paid us $10,000 of amount, and it's been 100 days since a customer A has another amount that they haven't paid. So this customer is the same, but this customer another amount that they haven't paid us, and it is also of $5,000. Sorry, not 50, $5,000. $5,000. So this is another amount that is remaining. So the name of this specific thing that you ask from the management is known as aged receivable listing. The appropriate name, the most technical appropriate name for this listing, that this breakup that you ask from the management, is known as aged receivable listing. So you ask the management to give you an aged receivable listing. From that aged receivable listing, you identify which customers are long outstanding, and then you discuss with the management the need against these receivables. You have to record an allowance because these are very old receivables, and once a customer knows that they have old receivables, they might not pay you back for those payments. So they have to record an allowance for this. So again, this is the response that I will write it down. And in the case of receivables, this is the only response that is present. You can learn it. There would be no changes in that. So the audit team should first discuss with the management whether steps have been taken to record allowances expense because of increased receivable days. So let's first discuss with the management. The next one would be again the same thing that I explained. The audit team should also obtain the aged receivable listing and identify old receivables and discuss with management the need to record allowances against these older receivables. So older receivable would mean that for these two, you can ignore them because these are quite recent. 30 days has passed since the customer hasn't paid. In this case, only 75 days has passed. But this is very old. You need to record an allowance against this, that this 5,000 wouldn't be received. This means from now on, the receivable balance in the financial position would be $15,000, and the $5,000, this balance has been written off, an allowance. This 5,000 would be recorded as an expense within statement of profit and loss. Got it? This is how we always record our answers, write down our answers, and this is how basically it is done within the practical life as well. Coming back towards question, we have already identified how many risks? 7, and then this was the 8th one that we have identified. So we are already done with the question. As a student who will be sitting within the exam, I will simply move forward and ignore these 2 paragraphs that are still remaining as a student, because I know 3 hours are not enough to do the audit exam. It takes more time to do the audit exam. And if one question I'm completely done with it, the requirement is 100% done. I had to identify 8 different risks. I have identified proper 8 different risks. I shouldn't read or write anything more down within the exam because it would just be a waste of time. I simply should move towards the next question. At the end of the exam, if I have some time remaining, then I can come towards this and write extra risks down within this question, but not right now. So, but this is the class, let's discuss it. Let's try to identify risks within this area as well. An instance of payroll fraud was also discovered during the year. A payroll clerk had set up a number of fictitious employees and the wages were then paid into the clerk's on bank account. Controls have now been implemented to prevent this from reoccurring, and the clerk involved no longer works for the company. However, the audit manager is concerned that the additional fraud may have taken place in the payroll department prior to the controls being implemented. Whenever you identify a fraud within the question, always remember, if the fraud has been identified, this doesn't mean that management would have recorded every single kind of expense against that fraud. So let's say if I was working within the payroll department, I created within the system a person by the name of person number Z, and with his system, my bank account was linked. All the salary that would be paid would automatically go within my bank account, but in the system it would show that this salary is for person number Z. If I am conducting this fraud, this means for how many months I received the salary, this was a fraudulent salary. I have done fraud. Whenever fraud is done within the company, what the management has to do, that all the expenses that happened because of fraud, all the cost that was incurred because of the fraud, for 3 months this was happening, after which the fraud was caused and the payment was no more being paid within my account. This means that for 3 months, $100,000, $300,000 of an expense will have to be recorded within profit and loss as a fraudulent expense. But this was identified from the management. They did an investigation and they identified fraud only occurred for 3 months. Cost is recognized as an expense within profit and loss. Fraud is not important for the auditor. No. Whether the expense has been recorded within profit and loss, yes or no, that is important for the auditor. Whether financial statements are correct or not, that is important for the auditor. That is all. I don't care whether the company is losing a lot of money because of fraud, yes or no. As an auditor, my only thinking is whether the financial statements are correctly recorded or not. The question here is, after investigation, the management of the company was only able to identify that 3 months of fraud happened. What if this fraud was being carried out for a whole 5 years? What if this fraud was being carried out for a whole 6 or 7 years or 6 or 7 months? You haven't recorded that cost within the financial statements as an expense within profit and loss. You haven't done that. No. So the risk is that there may have been additional fraud done by this payroll clerk. This specific person has done additional fraud within the company, which is not yet identified by this management. By the management of the company, they haven't identified the additional fraud, which is not yet recorded within profit and loss as an expense. This hasn't been done, because of which the expenses within profit and loss are understated and the profit of the company is overstated. So this is the risk in this case. Now, obviously, according to this, there is no standard related, so you can simply skip this third one, you can simply skip it because there is no standard related to a fraud. So that is why you can't write down about standard. But for the remaining 3 paragraphs, you will have to write down about it. So first paragraph, simple identification. During the year, fraud was uncovered by a payroll clerk. What is at the risk of under or overstatement? The expenses. If the management has not identified additional fraud that may have occurred, there is a risk that there might have been additional fraud. Management may not have identified it. This means that that is also not recorded as an expense within statement of profit and loss, which is understating these expenses. The expenses in statement of profit and loss could be understated. Why am I thinking that? All of the explanation that I just gave why I'm creating this fraud is basically the explanation itself. There is a risk that the payroll clerk has performed other significant fraudulent activities which have not yet been identified, because of which the expenses could be understated, as these expenses, if not identified, would also not have been recorded within profit and loss. There is also an increased risk that if due to control failure a fraud has occurred in payroll, other frauds could have also occurred during the year which are not yet identified. The same explanation, you don't need to write this one down. This is basically the same explanation for this one, that other fraud may have been done by this payroll clerk which have not yet been identified, hence also not recorded within expenses in profit and loss, which is creating this risk. Now, as an auditor, whenever you see that there is a fraud going in the company, fraud happening within the company, the first step is, wherever the fraud occurred, the affected areas within financial statements, increase your sampling to reduce the detection risk. Number one response will always be to increase your sampling for that specific area, because there might be other fraud there hidden as well, which is not yet identified. So number one response will always be to increase the sampling so that the detection risk in that area is reduced. Number two, whether the original things are properly recorded or not, first you need to discuss this with the management as well. So first, get an understanding from the management, what was the fraud for, how did it happen, all the ins and outs of the fraud, what accounts were made. You have to get to know this from the management. Then you need to understand whether all the entries regarding this fraud have been done appropriately or not. All the adjustments, the expenses that should have been recorded because of this fraud, have these been recorded or not properly. First, let's talk about that specific fraud that has occurred. Then you always say that as an auditor, we need to increase our sampling in the areas where the fraud occurred, because there might be other hidden frauds as well. The audit team should discuss with the finance director the details of the fraud to identify whether appropriate amount of expenses have been recorded in the profit or loss due to these frauds. So the frauds that was identified by the management, have the expenses been recorded because of this specific fraud? Right now, we are not talking about the hidden frauds, other fraudulent things that might have happened. Right now, we are only talking about the fraud that was identified. Have the expenses been properly recorded against this fraud or not? First, discuss this with the management. And you can learn this as well, by the way. But the second thing, additional testing should also be done. The audit team should also select increased samples to reduce the detection risk in the affected areas, and should also be more professionally skeptic in affected areas, as there could be other unidentified frauds that are still hidden within that area, because of which expenses have not been recorded. So this was the ninth risk that we have identified from this specific scenario, which I believe is really good because we got one additional risk. This is the ninth number of risk. Now let's move towards the final line that is still remaining within this question, and that is also very important. According to the examiner report for this question, the examiner has stated that 99% of the students who attempted this risk did it wrong. Let's see what is written here. William Knight, who is William Knight? The CEO of the company, would like the audit to be completed by 31st of October 2015. Okay, so he is telling me that the audit should be completed by 31st of October 2015. What is the year end of this company, by the way? What is the year end of this company? Oh, 30th of September. This is the year end. So 30th of September, how much time will I have to complete the audit? So the financial statements would be prepared for this year, and I will have to complete the audit. This is the only timeline that I will have to complete this audit. How many months do I have to complete the audit? September, October. Only 1 month? So in this period, I will only have 1 month to complete the audit? Okay. Now, you know what the examiner report states for this specific question, for this specific risk. This is a risk, by the way. This is a risk. This is the 10th number of risks that we identified. The examiner report for this question, in that examiner report, the examiner specifically states that 99% of the students who attempted this risk made one specific mistake. They forgot that this is an audit risk question. This is not an ethics question, because 99% of the students started writing down about ethics, that this would intimidate us. This would mean that we will have to cut a lot of corners and our audit quality wouldn't be good. This would mean that, and in the recommendation, in the auditor's response, 99% of the students wrote down that we should discuss with the management of the company that the audit time should be extended, at least 3 months should be given to us. This is what 99% of the students wrote down, which was incorrect. Why? Because of one specific thing. Those students forgot that this is an audit risk question that we are solving. This is not an ethics question. If we talk about audit risk, if you are identifying risks within your practical life as well, this means that ethics has passed. You have already agreed with the management that we will complete the audit within 1 month. That is why you are identifying, you are up to the next stage of identification of risks now. Because if this was an issue that had to be created, this should have been raised, issue should have been raised within the ethics stage, within the acceptance of the client stage. There you should have written down that this creates an intimidation threat. 1 month is not proper to complete the audit, and because of this would mean that we will have to cut a lot of corners, and this would reduce the quality of an audit. And in the responses section recommendation, you will let the audit team know that first you should discuss with the team, first you should discuss with the management of the company that please extend the timeline for us. This is what you should have written down within the ethics stage. If you are beyond that stage, if you are already identifying the risky areas within financial statements, this means that ethics is gone. You have agreed with the management to complete the audit within 1 month. Now, as an auditor, you have to identify what is the risk that would happen in this case. What are the risks in this area? The risk is detection risk. The time is so low that as an auditor, you may not be able to identify risky areas within the financial statement. Number one, there is a detection risk. Overall, there is a detection risk. Number two, the situation is that when does the management prepare the financial statements? Even I told you within a few previous lectures as well. If this is the year end of the company, the management would start from this date onwards and make the financial statements within the next 10 to 12 days. So management would hand over the financial statements to the auditor, let's say on 10th of October 2015. Then in the next remaining period, the auditor will complete the audit. So management itself needs to take 10 to 15 days to make the financial statements after the year end. They need to make the financial statements as well after the year end. And these financial statements would then be shared to the auditor, and the auditor will complete the audit within the next 3 months. If you are requesting that the audit has to be completed within 1 month, this means that the management now will have to complete the financial statements really early on. Because if they are taking 10 days to make the financial statements after this date, this means I will only have 20 days to complete the audit. I can't do that. This means that obviously senior individuals within the company would now pressurize the lower individuals that complete the financial statement, complete the financial statement. So they, during this pressurizing hours, and they will have to sit extra long hours, they will also complete the financial statement within 1 to 2 days and share it with us. And because they are taking lower than usual time, the risk is increased that there would be errors made within the financial statements because of so much early completion of the financial statements from the management. They would have done so many calculations so early on in so much less time that there is a high risk that they would have made a lot of errors during these financial statements. So the risk of misstatement has increased and the detection risk, both of those have increased. So we as an auditor, what would be the response in this case? The response wouldn't be that we should discuss with the management to extend the timetable. No. That is already done within ethics. The response would be to ensure that we as an auditor have already agreed to complete the audit within 1 month. That is why we are in the planning stage of the audit. We have already crossed the ethics stage of the audit. We are in the planning stage. We have accepted this client. We have accepted their requirement to complete the audit within 1 month. This means that now we need to complete the audit within the remaining days. We have to do it within the remaining days. Whatever days will be left, we will have to complete the audit. And we cannot assign junior members to the audit team. We will need to assign more experienced team members within the audit team as well. and we will also need to make sure that more sampling is done, because the risk of error has now increased because of pressure upon lower people to complete the financial statements early on. And both of these, to maintain them, we will automatically have to select a high number of sample, and more experienced team will now need to be sent who have the skills to make sure an audit can be completed while maintaining the quality in a short term period. So, identification of the risks. The first paragraph will be the identification of risk, in which I have written the CEO of the company has requested that the audit to be completed within 1 month after the year end. Good. The second paragraph would be what is at the risk here, which financial statements item is at the risk of under overstatement. There is not one financial statement item right now. The risk is that we may not be able to identify risky areas or misstatements within financial statement. The auditor may not be able to identify the misstatements in the financial statement. Why does this risk exist? Because of two reasons. The above reason risk exists because of detection risk, at the audit team will not have sufficient time to perform an appropriate audit of the financial statements, and that the client team will also have reduced time to prepare the financial statements, increasing the risk of misstatements and errors made by the management within financial statements as well, due to low amount of time remaining. Secondly, what would be the response in this case? We will have to send more experienced, very experienced people for this audit, because this is a new, first of all, this is a new year client. This is a new client for us. There is already a risk here. Now we will have to select a very experienced team. And those people, not just experienced, those people who have the skills to complete audit within time while maintaining quality. A more experienced audit team should be assigned to perform the audit of night incorporation, and the level of samples should be increased. It should be increased that the audit team consists of people of appropriate skills to perform quality audit in a reduced time. So these two will be the response that I will let the audit team know. That is all for this question. We are done with this question, and within this specific question, we have identified 10 different risky areas from the financial statements. Always remember, although I have written the answers to these questions down within the responses that will be given to you, the answer sheet that will be given to you, all of the questions which we have solved up till today are written here. But it is requested that whenever I do a question within these classes, within these recorded classes, still it is requested to you to please try to do the same questions yourself as well. After the lecture, try to do this question yourself first of all. After this question, you have to do it. Okay, so that's all for this lecture. I hope that everything that we did within this lecture was understood properly by you guys. And if there is any kind of question, always remember that I'm available. And up till then, up till the next lecture, take care, tata, and bye bye.